是梁燕，欢迎您来Astronomy 办公室领取属于您的一份圣诞礼物和新年礼物。这是我们为您特制的多层文件夹。我的地址在 Unit 771 Jellicoe Road 潘谬。谢谢大家。
As Mark, Andrew and I haven't really discussed at all with each other what we're going to talk about purposely, not just because we were enjoying what looked like everybody in New Zealand had an absolutely stunning weekend, or they did in Auckland at least. Certainly wasn't the case in London, being locked up at home, just to add to the torment of 4 months lockdown in New Zealand, to then go to another pseudo lockdown in London. But nevertheless, what we're going to do is we're going to each talk about what we think is the outlook and the things that we're looking at for 2022. But to start off with, let's talk Omicron. And I have a couple of interesting reflections on 2021. Well, I think they're interesting reflections on 2021. And then we'll go to the outlook and what we think is going to drive portfolios for 2022. Throughout the next half an hour or 45 minutes, if you have any questions, do send them through on the Q&A. We don't have a guest today. We've got time. And if there's any questions that you want to ask when we think about our outlook, then do please put them through on the Zoom Q&A and we can certainly answer them. So firstly, Omicron. As expected, and what you're certainly seeing in the UK and other European countries is Omicron is extremely contagious, and case numbers are doubling every 2 to 4 days. And while Europe is taking measures to slow the increase in the spread of the virus, this is predominantly to roll out the booster. And the booster vaccine is really one of the main lines of defense that European countries are thinking about. I guess the concern from a US point of view is that only 20% of the US have actually had the booster, and the percentage of people in the US that are vaccinated is actually extraordinarily low. But there are three key things to watch for over the next couple of weeks, which will really dictate probably how markets are going to behave from here on in. One is lockdown measures. So yes, in Europe you're getting headline lockdown measures, but they're certainly not as stringent as what you get in New Zealand and Australia. But certainly if we do start getting more stringent lockdowns, that will have an effect on some of the sectors within each of the economies that are affected by it. Number two is how severe or mild Omicron is versus Delta. Now, it has to, even if it's a lot less severe, the fact of the matter is the number of cases and how many more cases there are than Delta means hospitals will be stretched. But if you do have a mild, if the outcome is mild and the hospitalizations are significantly less than expected or significantly less than Delta, then that can only be positive in the sense of the requirements to protect the healthcare systems and therefore not have the stringent lockdowns that are perhaps required. The likelihood of finding that out is around the turn of the year. Those are the expectations that we've been told around when we get some real data around how severe or mild Omicron is. At the moment, it looks like it is more mild, but again, this thing's changing daily, and so that's something that we'll certainly track. And the third key reaction that we're looking at is central banks. And Mark's going to, I'm sure, despite us not talking about it, I'm sure he's going to talk about central bank policy and the Fed liftoff coming up in March next year. And certainly if Omicron is serious enough to have a change in that, and then we might get some perverse outcomes. For example, some of the shares that we've seen sell off recently may recover. So a lot of uncertainty, I think, is fair to say what the summary is of Omicron at the moment and how that affects markets, mostly to do with healthcare systems and the lockdown measures countries will have to have. Certainly at the moment looks less severe from a health perspective, but just the volume volume of people getting it. For those of you that don't follow UK news too much, about 90,000 people are getting it on a daily basis now, and that compares to this time last week, where about 40,000 people were getting Delta. And so you've had a significant increase in the number of cases in only a week. And I guess that's causing some nervousness. It'll be interesting to see how markets open today. A lot of markets are still being driven by what the Fed's doing and driven by what's happening in the US, but certainly this will have some effect, I'm sure, on how markets are thinking. But suffice to say, portfolio positioning hasn't changed from what we've been discussing over the last couple of weeks. We are conservative around what's going on with the Fed and what's going on with Omicron, that we've certainly taken significant risk off the portfolios, and that's a good position to be in the run-up to Christmas and New Year. Low liquidity, high uncertainty with variance, and a place that we're comfortably and happily remain for the foreseeable future. When I think about 2021, I jotted down some notes on some of the buzzwords that we've talked about over the last 12 months. And when we reflect on these, how many of them are going to be relevant for next year? Probably not many, but I'll run through them anyway. And in no particular order, the buzzwords were retail investors, Reddit, Gamestop, Delta, vaccines, working from home, Trump and Biden, transitory versus persistent inflation. If I think about word bingo and all the insights that we wrote throughout the year, I think transitory versus persistent inflation was one of the most written about topics in the NZ Funds Investment Insights. SPACs, ESG, Evergrande, cryptocurrencies, the commodities super cycle, the New Zealand housing market, TINA, or there is no alternative, and now, unfortunately, the final one is Omicron. The reason I mention those particular buzzwords is markets are fickle in terms of what affects them. If you remember when we were thinking about what's going on with the transition to the Biden government from Trump government on January 6th, there was a storming of the Capitol. Markets were nervous. Markets actually sold off. The VIX, or the measure of volatility, spiked because of it. And all hands on deck to work out what was going to happen. Was there going to be a normal passing of the president mantle from Trump to Biden, and were markets going to be able to absorb that sort of uncertainty? It obviously happened. No one's ever talked about it since. Markets moved on very fast, and that transition is well underway. And I think that's a really important point when you think about some of these short-term effects on markets. And certainly, we'd be the first to admit that it's been a really difficult year, and it's been a trying period for us and for you advisors and clients because of that performance. But a lot of the things that are causing some of these market drawdowns and performance difficulties are really, really short-term events. We're going to touch on it a bit later, but the commodity super cycle started off with a cracker of a first quarter and has really come a long way off since that as commodities and cyclical shares and commodities have come off. However, that commodity super cycle theme is still well and truly a theme that we think is going to drive the global, not just share markets, but global economies for some time to come. And we can't get dispirited by some short-term performance. And so when we think about some of these buzzwords, it's a really important indicator to think about making sure that we stay long-term in our thoughts. GameStop is another great example. GameStop was a big driver of financial markets 6-7 months ago. It actually ended up 700% for the year to date. So really is an amazing outcome for a company that's under a whole heap of trouble. But again, really doesn't affect what's going on in long-term financial markets today. The other 5 points I wanted to mention when we think about what's gone on in 2021 is that there's been $530 billion of IPOs in the US. this year. That's a record amount of raising of capital in the US ever. There's the highest of all time allocation to shares compared to bonds and cash of 53% across US retail portfolios. That is also monumental when you think about the flows of capital into shares, especially from retail investors. There were $1 trillion of share inflows into global markets this year, and that exceeds the combined total of inflows over the last 19 years. That is a huge amount of inflows into shares, and really what's driven the equity markets this year, and something that is just, we think, unsustainable over the long term, given on one hand there is no alternative, on the other hand valuations and multiples means that that cannot last and keep going. Retail assets under management is 12 times hedge fund asset under management, and so if you think about in a New Zealand context, Sharesies or Hatch, the same goes in the US with things like Robinhood and some of the more traditional brokers providing free services. And so you're seeing a huge increase in retail assets under management, but also things like KiwiSaver and the 401 equivalent in the US is really driving a lot of this inflows from retail investors. And the final point that I thought was interesting for 2021 is the 5 largest companies in the S&P 500 make up 25% of the index. That's up from 11% in 2015 and 18% in 2019. So the breadth of the market is really, really concentrated among just a few companies. And this is what you're seeing at the moment. You know, you've got a lot of uncertainty in markets, but depending on what Apple does is really depending on what the S&P 500 does. So what does that mean for our outlook? Well, there's a couple of things that we're looking at that, surprise, surprise, look very similar to our outlook from 2021. And those 3 are inflation and what we think are the inflation consequences going into 2022. And I'm sure Mark is going to touch on that, I'm guessing. And the second one is commodities. If you remember back to, for those of you that are hardcore listeners of NZ Funds Connects, the Hugh Hendry interview. And he was the gentleman that was in a white singlet, shorts on his sunny deck in the French Caribbean, drinking a white wine spritzer, talking about the commodity cycle. Turned out to be a really interesting interview. It's probably one of the highlights of the year for me in terms of that interview. But talking about that commodity super cycle and some of the drivers of that, and the fact that Hugh Hendry made a considerable amount of return for his investors in the previous commodity super cycle, and his views that this is actually the commodity super cycle, and the one that he participated in was a false start. That is certainly something that we are going to put our mind to, and we think it's important within that commodity space to put our mind to it for 2 reasons. One, with high inflation, a lot of the inflation is going to come from higher commodity prices. And so we think it's important, as inflation goes up and interest rates go up and shares come under pressure, that other asset classes, particularly commodities, can step into the fold and generate that return. But 2, commodities in the super cycle is really being driven from big structural changes in the global economy around decarbonisation. And Andrew's touched on that a number of times over the past 12 months around what that means for different types of assets within that commodity space. And it would be remiss of me not to mention the third thing that I think about when I think about the 2022 outlook is digital assets. We've had that layer 1 melt up in digital assets, and what does that mean? So Bitcoin, Ethereum at the start of the year really generated some significant returns. They're still up significantly. Bitcoin's still up 60% or so this year, despite it coming off from its highs later on in the fourth quarter. But now we're thinking about what next within this space. We started to get a glimpse of it in NFTs, or non-fungible tokens, and some of the use cases of cryptocurrencies within, I guess, day-to-day life. We're we're also now going to start seeing companies actually participate and operate within the blockchain environment. So whether that's being how to pay for music rights, how to buy and sell YouTube videos, how to buy and sell different content, and that's going to start being more prevalent, we think, in 2022. And if you don't believe me, if you've got kids that play computer games and like Fortnite or those other sorts of games, they're already trading these tokens, and these tokens are actually worth real currency. And we think in the gaming industry and the music industry and the content creation industry, this is going to be a huge sector to participate in 2022. When we think about active management, and perhaps the message for 2022 is there will be the haves and the have-nots. So some companies next year we think will thrive, and we really think from a share perspective, which don't forget shares still make up the majority of our portfolios. We think that the environment we're going into, or the paradigm shift that we're going into around rates and inflation, will mean that there's the haves and the have-nots. And I think Andrew might touch on some of the different sectors and drivers of the market, not just looking at the S&P, but things like small cap versus large cap, value versus growth. When I think about things to avoid, one thing that we certainly need to be conscious of is volatility. And we've discussed that a lot over the past couple of months, given what's gone on with performance since mid-October. And we certainly, when we think about some of the themes that we've been talking about, we need to make sure that we have access and investments within those different types of things, because we think that having just broad-based share exposure isn't going to give you the return that it has in the past. But we need to do so in an environment that is going to be volatile in a low volatile way. And we've discussed in some parts how we're going to do that using things like options versus the underlying commodity and positioning. But that is going to be the main focus for the investment team in 2022, is how do we take advantage of these things, and the fact that we can and do have the tools to take advantage of these things, but do it in a way that is at a reduced volatility. And so when I reflect on what is the biggest aim for me next year, it is around getting access to these things, but in a way that makes it palatable for us and for you as advisors and clients to participate in it. So that's my summary of 2021 and outlook for 2022. Mark, do you want to jump in? And I've kind of maybe steered you a little bit. I think we're probably on the same page in terms of some of the things you're going to talk about, but I'll hand it over to you and you can dismiss everything I've said. And,
Thanks, James, and morning all. I promise I won't talk about inflation. I think we've probably talked that one to death, so we'll let that play itself out this year or in the coming year. But I think, if I look at themes, the key theme is clearly tighter financial conditions, and I think that's going to be a global theme. At the end of the day, whether we like it or not, the US dollar is still the reserve global currency. So if the Federal Reserve is raising rates, that means they're tightening the money supply, essentially the availability of US dollars or the cost of US dollars. So that tightens financial conditions in the United States, but also globally. So in that environment, that would tend to be good for the US dollar. Historically, when the Federal Reserve has been raising interest rates, that's been positive for the US dollar. And it's generally made, as James intimated, it's generally made life kind of challenging for risk assets. So hence the haves and have-nots, which I think Andrew's going to talk to a fair bit. I suppose just as a slight digression, it does in terms of that commodity super cycle. If you have higher funding costs, that makes new projects harder to justify and get off the ground. So in some ways that actually has potential to extend the commodity super cycle. If the US dollar is strong, that probably means the Kiwi will struggle a bit. we continue to sort of see positives for the New Zealand dollar, but in an environment where the US dollar is going higher, it becomes a sort of real headwind for the New Zealand dollar. So generally the outlook for that would be sort of mixed, probably positive, but mixed for Kiwi. First, the other thing I suppose, expect to see next year, which we haven't seen for a number of years, is really a diverging growth cycle. In terms of Europe, they're in a different position, and clearly in terms of COVID versus the US, but also in terms of growth, and a similar situation in Japan. So, the discussions from the ECB, the European Central Bank, and the Bank of Japan definitely is still around providing financial monetary stimulus. So you have the Fed, which is tightening conditions, making money more expensive, whereas Japan and Europe aren't. So, we tend to expect that that reflects a diverging pattern of growth, and you'll continue to have strong growth in the US and probably less strong elsewhere. And that's another reason why we are positive US dollar for that reason, is that both the yen and euro don't look as attractive. Moving to credit, I think in an environment where the world is maybe a little more challenging, but we still need to step back and remember that there is pretty positive growth out there. In the US, looking at probably nominal GDP growth of more than 6%, or in the region of 6% next year. That's a pretty good backdrop for corporate credit. Corporate credit tends to be relatively expensive. It's pretty fully valued. But at the same time, even though corporates have a decent amount of debt on board, their earnings, their balance sheets are still strong, their earnings are strong, and you have growth going forward. So, and equally, probably the other one is, and as Andrew will touch on, most corporate credit is not really concentrated in the parts of the equity market that are probably more stretched. So that continues to sort of say credit we don't have any credit concerns about the year ahead. And the last point I'll make is really, I suppose, New Zealand, because New Zealand has been throughout the last 2 years sort of ahead of the rest of the world in terms of where the economy is sitting. And the critical theme for next year is really how New Zealand responds, how the economy responds to higher interest rates. The Reserve Bank has clearly signalled that they want to raise rates, and they have done so twice already, and they're going to continue to do so next year. And the wholesale market has responded and moved wholesale interest rates into that sort of 2.5% to 3% range. And correspondingly, mortgages are now firmly in that 4 to 5% range across the board. That's quite a big change for this economy after a period of very low interest rates. And mortgage rates at that level will take out around about sort of $2 to $2.5 billion of spending out of the economy next year as people roll forward in terms of and deal with those higher interest rate or higher interest payments. So, how the economy responds to that will be interesting. We're already seeing anecdotally that in Auckland and other parts of the country that housing markets are slowing in terms of and certainly prices have come off those sort of rather extreme peaks we probably saw during the Auckland lockdown. But on the other side of the coin, the government is continuing to spend, going to push a lot of money into the healthcare sector. That's positive for growth. And at the same time, we've got a very buoyant milk price. So a lot of the agricultural sectors are doing remarkably well at this point in time. So that balances it out. But broadly, don't expect interest rates to materially change at this point in New Zealand. They seem pretty well balanced here. And it's really a matter of sort of stepping back and seeing how that growth path plays out over the year ahead. With that, I might hand it over to you, Andrew, to talk a bit more about different equity sectors.
Thanks, Martin. Thanks, James, and good morning, everyone. Given Mark and James have talked at length about interest rates and touched on inflation, digital assets, I'll focus maybe some of my comments on the equity sector. And I think the main message I would have where I'm focused on for 2022 is risk within equity markets or share markets. And risk comes in many different forms. One of the key one of the key metrics that many investors will look at is overall valuation levels. So are equity markets or share markets in general valued at high levels by historical standards, but also by the risks that they see in the current environment. So, for example, sometimes you can justify higher price to earnings multiples for some companies, and that might be because there's a lower interest rate environment, or it might be the type of the companies and the speed in which they're growing at. And then other times you might say you can't really justify those high valuations. And I think the message I give for 2022 is that the markets are getting to more extended levels. And I'll just show a quick chart here. I like to often demonstrate my points with a graph. And this chart here is the price to earnings multiple for the S&P 500 going all the way back to 1990. And many of you on this call will be aware of what was going on in the late 90s, early 2000s, which was the dot-com bubble era, which was driven generally by growth companies in the technology sector that were trading at extremely high multiples, had very little earnings but had very high market caps. And that drove the price to earnings multiples of the S&P 500 to about 26 times. If you actually focused on the NASDAQ and more tech companies, then the multiples were a lot higher. Now what you can see is that rolling forward to today, we're not quite at those levels, but we are at very high levels compared to history. So that to me is an area that needs to have focus. And I mentioned before that sometimes when interest rates are low, you can justify high valuations. Well, we are in a low interest rate environment. And so a lot of these high valuations can be justified, and that is why ourselves and many investors have stayed relatively long equities throughout this year, because we're not saying, look, we're above long-term averages, we need to go to low equity exposure, because a lot of it is justified. However, it means the risks are higher. And as Mark's talked about an increase in interest rates, well, we are in that environment now. And historically speaking, when interest rates are rising, it can push down the prices of assets. And this comes from all forms, well, this applies to all forms of assets, such as companies and share markets, but it also applies to houses, for example. If you're in a declining interest rate environment and mortgages are getting cheaper, in general, housing prices increase, and that's exactly what we're seeing in New Zealand as mortgage rates have approximately halved. We're seeing a 30% increase in housing prices. And so for the same reason, you might be a little bit nervous on the price of houses as mortgage rates going back up to 4 to 4.5%. Well, the same reason, for the same logic, we look at share market valuations and we're a little bit more careful. What I would say is we don't see it as an environment that we sit here going, look, let's be significantly reduced equity exposure. And that's because these high valuations can persist for a long time, and in some instances where the companies are growing really fast, of which a lot of the sector is, or a lot of the sectors in share markets are at the moment, they can justify these valuations. But where I think we need to be very focused in 2022 is the types of companies you're owning. So you need to sit back and look at the environment and say, if we've got a high inflation environment, we've got increasing interest rates, we've got certain concerns such as new COVID variants coming out, what types of businesses do we want to own? And to some extent, over recent months and to some extent throughout the year, investors have already been positioning for this environment. And typically what you would do when these risks get higher is you want to own safe quality businesses. Now, these are companies, in general, when you sort of measure a company for quality, people look at different metrics, but some of the key ones would be low leverage or low amounts of debt on the balance sheet. And that's because if interest rates are increasing, you want companies that don't have that much debt, and therefore they're not going to be paying a significantly larger amount of interest expense in this higher interest rate environment. You want companies that have got strong margins and strong cash flows. So if you've got strong margins and cash flows, that means you're constantly generating cash, which you can choose to pay that as a dividend or do a buyback on your stock, or you can use that cash flow to retire more debt if you need to. So if you're going through a riskier environment and you're getting comfortable, you can reduce your dividend, pay back more debt, and you've got cash, which effectively acts as protection and safety. You often want to look at companies that you think can perform in many different types of cyclical cycles. So these are companies that even if inflation is going higher and their cost base is going higher, they're able to pass those prices through. And And so, I always give an example of a company like Apple, which, although it's got relatively high cost base because it has to produce a lot of phones, Apple has got such a strong brand and reputation, they can put up the prices of their iPhones by $100 or $200, and by and large, most people will continue to buy these products. So if the cost of wages goes higher and Apple's losing money because they're having to pay their employees a lot more money, they can also pass that through in general into their products. You also want to look at companies that are generally just larger and more stable companies. And I know it can be a little bit simplistic at times to say you want to own large businesses because it's risky, because certainly not all large businesses will do well. But generally companies that are, say, in the largest 50 or 100 companies, the S&P 500, are there for a reason. They're there because they are good quality long-term businesses which have shown an ability to grow over many, many years. And so often these larger companies are going to display a lot of the characteristics I've just mentioned about good margins and strong growth. You also generally want to look at companies that have lower earnings valuations, such as price to earnings multiple, EBITDA multiples, and this is because if you're in an environment that becomes riskier and more uncertain, and the growth outlook is also less uncertain. If you're trading at a lower multiple to your earnings, that effectively means your valuation has less, has a small amount of distance that can come down. For example, a bank that's trading on a 10 times price to earnings multiple might re-rate from 10 times to 7 times, but you might have a technology company that's trading on 80 times price to earnings multiple, and that re-rates down to 30 or 40 times. It's got a much bigger distance to come down. And sort of to show this point to some extent, I want to show you a chart of what's been going on this year between quality businesses and technology businesses. So this is going from 1st of January this year. The blue line here is non-profitable technology companies, which have had a very volatile year. And the white line is a basket of quality companies. It's actually a basket we've put together at NZ Funds. What we did is we went through the largest 50 companies in the S&P 500, and we picked the 15 or so companies which we think displayed the highest characteristics of quality on all those measures I've just mentioned. Now, what you've seen this year is that the quality index has done relatively well. It's up 25% year to date, and it's grinded up in a pretty consistent pathway higher. Whereas you've seen the non-profitable technology companies have actually finished the year at the moment down 22%. So there's well over a 40% difference between these non-profit companies and the quality companies. And in particular, in the last month or so, we've seen a massive dive in these non-profitable technology companies. Now, the reason that's happening is the market is getting more concerned about interest rates increasing, more concerned about inflation, more concerned in general about the overall valuation in equity markets. So what the market's been doing, particularly recently in the last month, has been selling these riskier companies and have been buying the quality companies. Now, I think we'll continue to see this volatility throughout 2022. I think we'll see periods where this blue line, the high valuation tech companies, they come roaring back, and then I think we'll see periods where these quality companies underperform. But I think it is likely that we continue to see this divergence. And the reason I say that is I'll jump back another year to the start of 2019. And from the 2019, we've seen massive outperformance in these technology or these non-profitable technology companies. So it looks like they've lost ground over the last year, but in reality, they're up 140% over a 2-year period since before COVID, compared to only 41% for these quality companies. So from an equity perspective, that means someone like me is just going to be really, really focused on the types of businesses I'm in, the sectors I'm invested in, the balance between the portfolio. We're not going to put all of our eggs into one basket and just buy quality companies, because if your entire portfolio is just quality companies and you get a bit of a reversal and a bit of a risk on movement, then you can really underperform, and vice versa. We're not going to take a massive bet that non-profitable technology companies are going to outperform. So we'll have a little bit of balance between both, but we'll put tilts towards where we think the companies will outperform the most in the foreseeable future. So at the moment, we're spread, but we're sort of underweight technology companies, but we've got a more overweight to inflation beneficiaries and some commodity commodity businesses and some quality companies. Which brings me to sort of the more commodity type sector or themes for equities. In an increased interest rate world and high inflation, you often see some parts of commodity sectors outperform. And so this ties a little bit into some of the points that Mark and James are talking on about commodity super cycles. So I won't go into it all into complete detail, but the point I want to make is that there has still been an underinvestment generally in new commodity capacity over the last decade or so since there's been a commodities bear market. That has only got worse throughout the COVID-19 environment, and the demand has bounced back much stronger than people expected. And so we're still seeing various areas such as uranium, such as in copper, aluminium, where there's been an underinvestment and prices are rising. I think that will likely continue in 2022, and I think that will continue throughout the rest of the decade to some form. And I think this will create opportunities within many subsectors of commodities in the share market. We've all talked about uranium, and I don't think anything changes on that front in 2022, but in other areas such as copper or aluminium, which are particularly exposed to the green energy cycle or decarbonisation, I think can outperform. One other sector I'd like to talk to is financials and banks. Brooksy would be able to talk about the impacts of increasing interest rates on bank earnings in detail, but in generally an increased interest environment is good for banks. These banks will lend at a higher rate and they'll finance themselves at a rate that might be a little bit higher, but generally they capture that spread on increasing interest rates. And they also trade generally at low valuation multiples, such as 10 times price to earnings for some of the US banks, maybe a little bit higher for the Australasian banks. But in general, they're seen as value companies of good quality that can perform in high interest rate environments. So I've chucked out a lot there, so I might pause, see if James and Mark have got any other equity sectors you'd like to add, and please go ahead.
Thanks, Andrea. It's really good summary, I guess, of some of the themes that we're thinking about for share markets in 2022, and really it's going to be a rich environment for some of these different sectors within the market, and I guess the breadth is to our favour as an active manager, because you can really start seeing some good value companies. Look, I want to spend 5 minutes talking about portfolio positioning now, in the context of what Andrew, Mark, and I have been talking about. So the 4 key reasons for portfolio underperformance this year, and we've gone over it a number of times, but just to recap in 4 very quick bullet points. Commodities have been more volatile than expected and have been negative in terms of their returns. Cyclical shares have underperformed the broader market, and this is really based on the last few months when there's risk-off type of market events. Cyclical companies, as Andrew pointed out, tend to underperform the market, and that's what we've seen. Cryptocurrency is significantly off their highs. Now they've still, over the year, have performed extraordinarily well, but in the last few months they're off 20-30%. And the final one is interest rates. They just haven't increased to the extent that we would have expected on a global interest rate basis, predominantly in the US. So what are we doing, though, within the portfolios to make sure that we capture those returns back, given we still have high conviction across a number of those themes? And what I did was prepare a really quick table of what the growth and the growth and inflation shares look like when we think about the portfolios. So as you can see here, this is done across different asset classes, and you can see a good weighting still towards international and Australasian shares. In the growth portfolios, it's weighted towards international. In inflation, it's weighted towards more Australasian, because you get some lower volatility and higher dividends and a bit more of a conservative outlook for those shares. And then you can see that while we have performance has struggled because of some of those themes that we talk about, we still have high conviction within them. And so we still have positions within digital assets, commodities, and interest rates. And as we look for those different asset classes to start moving in the direction that we expect that they will, we're already positioned well in those. Now, a majority of those within the commodity space, for example, are options, which means that if you do meet your price targets, then you can get some significant returns within the portfolio. The options were not what caused the losses within the portfolios. I know there was a question around in the Q&A about who was responsible for putting on the options. Well, that's obviously buck stops with me there on who puts the options on. But those were not the cause of the losses. The cause of the losses were around some of our key positioning within the commodities and the commodity shares. But what this means and what that table describes is we still have really good broad exposure to different asset classes that when markets start thinking about more longer term themes and events that we've just discussed, we're well positioned to perform well. And we're excited and about some of the things within the portfolio, notwithstanding short-term volatility brought upon by Omicron. But within the portfolios, and when we think about more longer-term performance, we think we're really well placed, rather than being predominantly invested in an S&P 500 type investment where, yes, while that's been a strategy that's probably worked over the last few months, over the more 2, 3, 5, 10-year period, given where interest rates are going, that's just not a strategy that we think is something that will produce returns over time. Looking at some other questions within the Q&A that have come through, thanks for all these. A2 Milk, Rick wants to know about A2 Milk, and given their low debt levels, their pivot away from how they export to China, do they meet our requirements? We don't actually own A2 Milk within the portfolios at the moment. It's one that Andrew and I work on together. It's a company that really disappointed in terms of one of the red flags that you get taught in Finance 101 is if the management team starts selling their shares, then you know that there's a serious problem. And they significantly sold a good amount of their shares over the course of the year, particularly in August. And really, you need to earn the trust back. And it's something that we'll be looking at. But when I look at the share price is now trading at exactly what it was when I first started at NZ Funds in 2017. And so it's been a bit of a journey, but every company has its valuation. It's now at a pretty dire valuation compared to what it was, and never say never, but it's certainly one that we do work on because it's still in the top.
I think we sort of think it's a little bit too early to take a big bet in long position in A2 because it's as James said, it's had a massive pullback and the share price has come right the way back, but the uncertainty in A2 is still really, really high. This company had a big valuation previously that was driven by the fact they had a huge growth opportunity in China. That growth opportunity now is significantly more risky given what's happened with their Daigou channel. And it's more difficult to attach high certainty to the cash flows that they may or may not earn going forward. And so the company's got a lot of work to do to convince the market that China, that they can regain confidence in the market for growth in China. And so we need some more data points on that. I'm certain there'll be a point. I don't know whether it's this year, 2022 or 2023, there'll be a point where we buy A2 Milk again. But it's not right now.
Neil asked about China and their elimination COVID strategy. Neil, that's a really interesting question and one that I've actually been working on today with a few people in London specifically on that. And that is certainly something that we need to watch because if China continues with its elimination strategy of COVID, they've now got 130 cases of Omicron, which probably means they have 130,000 cases of Omicron. Are they going to go through a hard lockdown? Now, what are the implications of that for global markets? The predominant one is supply chain, which was what we saw this year. And there is rumour, and always get your facts before and don't trade on the rumour. But there is rumour that a major port in China, where they had one of the outbreaks this year, which caused some of the supply chain issues, is actually closing again because they've got an outbreak of Omicron at that port now. Who knows if that's actually the case, but it's certainly something that we need to watch. What does it mean if China do go into lockdown in the supply chains? Well, it just continues to affect those supply chain costs and affects inflation. Does it affect global growth? Perhaps. But it's more around that supply chain and the pressures of inflation if we do see it. So, Neil, it's just interesting that you asked that, given what I've been looking at over the last few hours or so.
I think one thing, James, I would just add to that is just sort of stepping back. Remember, China does, from a monetary standpoint, they have not sort of lowered interest rates to the extreme levels that you've seen in other parts of the world. So essentially, they have firepower to come to the party if they feel they need to really stimulate the economy at some point. So very much the property side, that's been a managed slowdown. They've looked to really effectively engineer the default of Evergrande and a few others. So they are looking to manage that. But if things sort of start to become more challenging for them, they do have that capacity to stimulate the economy if they choose.
And that probably goes to Matthew's question around the Chinese property market and its effects on commodity and export countries like us in Australian markets. It's certainly, they have firepower to stimulate their economy if needed. But I guess they also want the property market to slow down because they're sick of being a one-trick pony type economy.
Yeah, and that sort of coming back to that commodity super cycle issue, that sort of creates the yin and the yang, I suppose, of that discussion. Something like copper, for example, clearly a major winner in the electrification of the world. Copper is used in everything electric. But at the same time, 50% of demand comes out of China. So if Chinese demand is slowing, that creates sort of a headwind against a sort of maybe more of a medium to long-term tailwind.
And then the last question we've got up is rare earths. So that's also another interesting question, Miles, around rare earths such as lithium and how they fit in. That's certainly a theme that we're looking at for 2022. It's when we think about the volatility that we experienced in some of the commodity positions this year, rare earths is certainly a sector that would be volatile. And so we need to be careful around how we access those markets if we do want to. But lithium is one, palladium is another. And it's a really interesting sector.
We own a small amount of rare earths via one of the uranium miners that we own in the US, a company called Energy Fuels. It does a mix of uranium and rare earths. The problem with the reason we haven't taken a large direct position in rare earths is quite uncertain. It's harder to value than uranium, given the demand and uses are relatively opaque. So you can't really build up a really easy kind of, this is the amount of rare earth minerals coming out of the ground, this is the demand, as easily as you can with something like uranium. So uranium is much clearer. So that bull thesis for us has got a very high amount of conviction. And then lithium is a really interesting sector. It's a sector that we have done a little bit of work on. We will continue to do some work on and try to find the right exposures for it. But at the moment, we don't have a direct position in lithium.
Well, that's all there's one more read. The tilt between New Zealand and Australian equities and the inflation, given the weighting shown early in the outlook for the Australian positions. So that was Australasian in terms of what we showed on that table before. And essentially, Reid, it's a good question. Essentially, we were 50-50 Australia, New Zealand throughout this year. That was a good decision because Australia outperformed the New Zealand market. If you think our benchmark is 70-30, so we were significantly overweight Australia and underweight New Zealand. We've balanced that up a bit, and the reason for that predominantly is the interest rate move has already happened in New Zealand, and so some of these high-yielding stocks have kind of gone through the pain of an increasing interest rate environment. And we think now is a pretty good value, pay a nice stable dividend. And given the lower volatility of some of these New Zealand shares going into uncertainty, actually we're pretty happy to be there. If you think of the shares like Meridian and Mercury and those sorts of companies, Spark, that theme doesn't change really, does it? Now there is risk as interest rates increase, they get into a little bit of strife, but we've had that initial move as Mark's talked about, and so we're happy to be there at the moment, and so we balance that overweight back to being more aligned to the benchmark of 70-30 New Zealand, Australia, maybe slightly more in Australia than benchmark because of that bank exposure that Andrew talked about. Look, we're right on the hour. There's plenty to talk about, which makes me excited about reconvening in 2022 and taking what we've learned from 2021 and really thinking about how we can generate some strong performance in an otherwise volatile and uncertain market that's going through quite a major paradigm shift, not to mention short-term effects such as COVID. So really appreciate all your attention this year and all your feedback. It's been a difficult year. We are absolutely focused on making 2022 one that is an experience that both advisors and clients can look at and experience and be proud of, and that's what we're going to be focused on for 2022. So we hope you can join us on our Monday calls when we start them up again early in the new year. We'll send out the invitations of when that happens. But until then, we wish everyone a happy Christmas, a great new year. Enjoy the freedoms that we've got, and look forward to talking again soon. And in the interim, if you do have any questions or concerns, you want to discuss the portfolios, the main drivers of what's happened this year, how we're positioned to recoup and generate positive performance next year, do let us know. We're here to help and we're here to chat, and we'll be more than happy to do so either with you or with your clients, or for those of you that are interested in what's going on. Thanks, Andrew, Mark, for all your contributions this year. Much appreciated. Thanks to all our guests who were on throughout the year, and we've got a good lineup of guests next year as well. So there's going to be a cracker 2022. So thanks everyone, and have a great rest of your week, and enjoy those Christmas parties if you've got them.
Thanks everyone.